Personal finance practice problem using OneNote. Annuity due present value calculation. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab. We're down in the 1235 Annuity Due Present Value tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at that present value of an annuity, but focusing in on an annuity due, remembering that normally when we think about an annuity, the payments taking place are typically happening at the end of the period. They have to be even intervals for it to be able to be calculated as an annuity, and we assume they are all happening basically at the end of the time period. You could have even intervals where they all happen at the beginning of the time period, which we need to remember is not the conventional way when we just think about a normal annuity, but is a way that we could set the system up to do the calculation. So our information up top, we're going to imagine we receive $1,000. The rate is going to be 5% for 6 years. If we have that type of annuity and we just do the normal type of annuity, first thinking about this with an Excel equation, it would look something like this. We would have the negative present value. The negative is simply to flip the sign so we don't get a negative result, but a positive result. That negative could also be in front of the payment, but I like to just put it up in front of the P. And then we got the brackets, and we pick up the rate, which is going to be the 5% on the rate. Nothing new there, comma, number of periods. The number of periods would then be 6 periods that we'd be picking up here, comma, and then the payment is going to be $1,000. That would be the normal annuity, which would generally stop right here. You wouldn't need this other 2 commas and a 0, because if you didn't put anything beyond the payment, then Excel would assume that it is an annuity, and if you do not indicate otherwise, it would assume a normal type of annuity where the payment's then happening at the end of the period. But if you want to indicate that what the payments are, you can then have another comma, which would skip the future value term here, because the future value term usually is used for non-annuities, and so we use the payment for the annuity and then get to the type field. The type field is the one that can tell us whether or not the payments are happening at the beginning or end of the period. Now, in this case, if it's the normal end of the period, like a normal annuity, you could go out here and type a 0 in to the type. There's also a little indication when you type this into Excel, it'll tell you this is at the beginning or end, so you don't have to memorize that it's a 0 or 1, because it'll give you a little thing that'll tell you that. But 0 would be normal. So you don't really need to go out and put a 0, because that's what it would be by default. That's why we've never gone out to the type field before and typed that in when we do a normal annuity as we have here. We'd get the 5,076 if we had not typed the 0 and just left it at not these 2 commas and just had an end bracket, we would get to the same number. Then if we want to say, okay, it's an annuity where the payments happen at the beginning of the period, that's when we need to then add that type field. So the beginning part would all be the same. Negative present value, the rate's still 5%. The number of periods would still be the 6, and the future value, the payment would still be 1,000. Then we'd have 2 commas to get us over to the type field, and then we would indicate that we want the payments happening at the beginning of the period, this time that being indicated with a 1, which would result, as you can see, with a different number that would be resulting here. It's a larger number because, again, the payment's happening at the beginning, so you would expect then the interest to accrue, sooner as the payment is happening at the front end. Now, we will go to a running balance type of calculations, but sometimes it can be a little bit more confusing to think of these present value calculations when we kind of verify it with a running balance calculation. Sometimes it's a little bit easier to think of these annuities going forward. So I find it helpful oftentimes to show this same annuity as if it's going forward, comparing and contrasting, instead of where we would be at period 0 to where we would be at period 6. And that way, sometimes you can think about the flow of the payments and think about where you would be in the future. And then if you were to take that future period, you can present value that back to 6 periods, and you'd get to the same result sometimes that helps to kind of make this stuff click. So let's do that this way. One more time, what we're going to do here is now do the future value, same annuity, but now we're not going to take it and value it back at period 0, but we're going to say what would the value be 6 years from now in the future, and then we'll take that 6-year out amount and do a present value of 1 calculation, bringing it back to the present, period 0, which we should get the same number as we got up top for our normal annuity here. Then we'll do the same thing for the annuity due, just to run it both ways. So in that case, we're going to take a future value, normal annuity. Future value, the rate would then be the 5%, comma, number of periods, which would be 6, comma, the payment would be the 1,000, and then we could go over here to the type, just as we did before, to indicate that it is a normal annuity, but that's not necessary because normally it will be a normal annuity by default. That's why we haven't been using the type, and then we will use the type when it's the deviation annuity due. That would give us the 6,806. So if we saw this annuity going forward 6 years out from now, it would be valued in those future value terms, 6,802. If I then took that 6,802, valued it back with the present value of 1, not an annuity, then I can get back to the current time period, right? So now I can take that number and say present value, the rate, 5%, comma, number of periods, which would be 6, and then comma, comma, because this is not an annuity, to get to the future value of that 6,802. That then would bring us back to the 5,076, which is this number here. The reason I think that's useful is because it helps you to kind of see the relationship between the future value and the present value. And sometimes it's easier to think about, the cash flow to do a running balance calculation to project out into the future. Sometimes that makes more sense to people. You could do the same with the future value of the annuity due. So this time we're going to take the future value of the annuity due, and then we'll present value it back 6 periods. So the future value would be negative future value. The rate would once again be the 5%, comma, number of periods would be 6, comma, and then the payment would be the 1,000. And this time we want an annuity due at the beginning of the period. Therefore, we have to have 2 commas, get back over here to the type, which we want to indicate type 1, which will make it an annuity due, meaning payment happens at the beginning as opposed to end of the period. So that would then give us a different result here. That would be the value of the annuity due 6 years out, which we can then present value by simply present value of 1, that number back to the current point, negative present value of the rate, which would be then the same rate, that 5%, comma, number of periods, which would be 6, and then comma, the payment, which we're going to skip now, 2 commas, because it's not an annuity this time, and then pick the future value, which would be that 7,1042. And so if we present value that, we get the 5329, which represents the same number we got up top when we took the present value of the annuity due calculation. Okay, now let's do it again. This time we're going to do a running balance type of calculation. This will be the running balance calculation to kind of verify that present value of the annuity, which looks something like this. We're going to take the end result, that 5,076 that we got basically up top with the normal annuity here and the normal annuity here. And when we do our running balance, we can do it something like this. We can have our number of periods, which is going to be the 5 or 6 periods. We then have the amount that we're going to calculate for the payment, and then the payment going out. And at the end of this process, we're going to get back down to 0 to kind of prove that this is the proper number with regards to our present value of the annuity. In other words, we're saying if you had 5,076 and you were to take out $1,000 for 6 years, taking out $6,000, then you would end up at exactly 0 if we were able to generate the 5% return on it. So that would be the idea here. So we got the 5,076. If that was to earn a 5% return, 5,076 times 0.05, that would be the 245. And then we have another, and then we're going to take out the 1,000. So obviously the increase is less than the amount of the payment, which makes the balance go down. So we're going to take the 5,076 plus the 254 minus the 1,000. That would give us the 4,330. Let's do that a couple more times. 4,330 times the 0.05 is going to give us the 216. Another 1,000 goes out. So now we've got the 4,329 plus the 216 minus the 1,000 is going to give us then the 3546. Taking that times the 0.05, we're going to get the 177. 1,000 goes out once again. And so if we take then the 3546 plus the 177 minus the 1,000, we're going to get then to the 2723, and so on and so forth. And if we go to the end of this, we'll end up at 0, basically proving that the value would be equal to that 5,076, because the series of payments, would result in a 0 ending balance here as you go through. Now, we could do the similar kind of thing with an annuity due calculation. Now, assuming the payments happen at the beginning of the period, comparing this then to the second calculation we did up top, so that 5329. So if I go back down, annuity due, we've got then the ending balance here. Our beginning balance is over here. So we'll take the beginning balance 0 and 1, beginning balance, there we have it. Okay, so now we're going to say, we're going to start off, and I'm going to start off basically at period 0, which is going to be that 5329. That's the amount we got here on the annuity due. And then we're going to say that in period 1, we're going to have the $1,000 payment now happening at the beginning of the period. So then we're going to be taking that 5329 minus the 1,000, means that at the beginning of year 1, in this case, at January 1st, we have a balance of 4329. Then we're going to take that times the 5%, 0.05. That's going to give us our 216 that happens in period 1 now. And that means the ending balance will then be the 4329 plus the 216, or the 4545. Then in period 2, let's go ahead and pull this over here. In period 2, we got another 1,000 that comes out in January, the very beginning. So we had our ending balance at the end of year 1, 4546 minus the 1,000 means we have a beginning balance you can think about in years January 1st of the 3546 times the 0.05. What we're going to earn during that year is going to be the 177 plus the 3546 would give us an ending balance of the 3723. If we did that again, we're taking another 1,000 out at the beginning. That means we had the 3723 minus the 1,000. So at January 1st, in essence, we got the 2723. So we got the 2723 times 0.05 means we earned during the year 136. So if we take the 2723 plus the 136 end of the period, we then have the 2859, and so on. If we take another 1,000 off year 4, we're down to 2859 minus 1,000, 1859. We're going to earn on that 1859 times 0.05 during the year, 92, plus the 1859 gives us an ending balance at the end of the year, 1952 minus another 1,000 means we're now down to 952. So 952 times 0.05 means we earned, hold on a sec, 952 times 0.05 is going to mean we earned 48, about 48 plus, something funny happened there. Hold on, that's okay. We got 952 plus 48. We're almost done. We're almost there. Don't fall apart now. Don't fall apart now thing. We're to the end. And then we're going to say another 1,000 goes out, and that brings us, of course, down to 0. We're not going to earn anything at this point because now we're at 0 and we have closed it out for the 6th period.